If you ask most people which protects capital better in 2026, AI investing or traditional investing, they usually answer too quickly. Some assume AI is automatically safer because it is faster, data-driven, and emotionless. Others assume traditional investing is safer because it feels familiar, simpler, and easier to trust. But that is not the real comparison. Because capital is usually not lost because something is labeled AI or traditional, it is lost because of poor structure, poor risk controls, emotional decisions, and systems that look safe until markets stop cooperating. That matters even more today because investors are operating in a much more complex environment than they were a decade ago. Inflation has moderated, but purchasing power is still under pressure. Interest rates remain structurally higher than they were during the 2000s. Markets react faster, volatility appears more often, and individual investors are still expected to make high-quality decisions in environments that move faster than human emotions can process clearly. So the real question is not simply which is better, AI or traditional investing. The better question is this: which approach protects capital better when markets become emotional, unstable, and difficult to navigate? And the honest answer is not as simple as most people think. When people hear traditional investing, they usually think of long-term portfolios, mutual funds, ETFs, retirement accounts, and buy and hold strategies. When they hear AI investing, they picture algorithms, machine learning, automation, and systems making decisions at high speed. But from a capital protection perspective, that framing is incomplete. Traditional investing has one very important strength. It is familiar. It feels easier to understand. It feels easier to trust. And in many cases, simplicity helps investors stay committed for the long term. But traditional investing also has one major weakness. It still depends heavily on human behavior. And human behavior is often where capital protection breaks down. People panic during downturns. They hesitate after recoveries begin. They increase risk when confidence is high. They confuse being active with being in control. That is one of the main reasons many investors underperform even when they have access to good investments. So before we go further, here is the most important idea in this video. AI does not protect capital simply because it uses technology. Traditional investing does not protect capital simply because it feels familiar. Capital is protected by structure, discipline, risk management, and decision quality. That is what we should actually be comparing. To make that comparison more practical, here is a quick overview of how we approach automation inside the automated trading network ecosystem.
At ATN, we help everyday investors access private, institutional-style trading systems that used to be reserved for hedge funds and ultra-high net worth individuals. The model itself is hybrid by design. Automation handles execution and monitoring around the clock, enforcing rules consistently and without emotion. Experienced professionals oversee strategy, risk management, and changing market conditions. Our clients aren't looking for excitement. They're looking for consistency, transparency, and peace of mind. Our clients want growth, but not at the expense of control. ATN was built on the idea that real automated income should simplify your life, not add more stress to it. If you agree with that and are interested in learning more, there should be a link to speak to us in the description of this video.
Now that you understand the structure and control framework behind our model, let's step back and answer the broader question clearly. When the goal is protecting capital, where does traditional investing help? Where does basic algorithmic trading fall short? And where does a more advanced automated trading network create an advantage? Traditional investing still has strengths that matter. First, it is easier for most people to understand. A diversified portfolio built around long-term ownership can be explained in plain language. You can understand what you own. You can understand why you own it. And that clarity matters because confusion often leads to bad decisions. Second, traditional investing can work well when the investor has the right time horizon, the right expectations, and the emotional discipline to stay consistent during volatility. Third, good traditional planning can help investors think beyond returns. It can help with taxes, spending, retirement timing, income needs, and long-term asset allocation. That is important because protecting capital is not only about what you buy. It is also about how you behave and how your financial life is structured around those decisions. So this is not a video claiming traditional investing is outdated or irrelevant. It is still valuable. It still has a role. And for many investors, it remains an important part of a serious portfolio. But traditional investing becomes weaker when markets become more volatile, decisions become more emotional, and execution discipline starts breaking down. That is where technology starts to matter more. This is where many people get confused. They hear automation, algorithmic trading, AI investing, and automated trading, and they assume all of these mean the same thing. They do not. Basic algo trading often means a strategy is running rules automatically. That sounds impressive, but on its own, it does not tell you enough. A basic algorithm can still be fragile. It can still be over-optimized. It can still be built only for one type of market. It can still lack real human supervision. And it can still expose investors to unnecessary risk if the structure around it is weak. In other words, automation by itself is not the advantage. What matters is how the automation is structured, how risk is managed, and whether experienced human oversight exists when market conditions materially change. That is why there is a major difference between generic algo trading and a more advanced automated trading network. A serious automated trading network is not just software placing trades. It is a full structure. Human professionals define the strategy framework. Risk rules are set in advance. Technology handles execution with consistency. Performance is monitored continuously, and human oversight remains in place to evaluate changes in market conditions and keep the system aligned with the original risk philosophy. That model is far more mature than the type of black box automation most people imagine when they hear the word algorithm. This is the part that matters most. If the goal is capital protection, the strength of a network like automated trading network is not that it removes humans completely. The strength is that it removes the worst parts of human execution while keeping the best parts of human judgment. That is a major distinction. In weaker systems, humans make emotional decisions and technology is barely helping. In weaker automation products, technology makes decisions, but there is little meaningful oversight, little transparency, and little adaptability when markets change. The stronger model is a hybrid one. Humans define the rules. Humans set the risk framework. Humans monitor broader market context. Technology handles execution with speed and consistency. And because execution is systematic, panic, hesitation, and impulse are reduced. That is where protection becomes more realistic. Not because losses disappear, not because drawdowns never happen, but because the process is more disciplined. And discipline matters enormously in modern markets, especially when markets move faster, react harder to macro events, and punish emotional decision-making more quickly than they used to. Investing in 2026 is not the same as investing in 2015. The environment is less forgiving. Inflation may no longer be at crisis levels, but the price reset is real. Government debt remains high. Geopolitical uncertainty is still present. Interest rates are higher than the ultra-low era investors got used to. And volatility can appear suddenly across currencies, commodities, equities, and broader risk assets. In that kind of environment, capital protection becomes less about opinions and more about process. This is why more serious investors are exploring structured automation, not because they want hype, not because they want shortcuts, and not because they believe technology can eliminate risk. They are exploring it because disciplined execution, predefined risk rules, and continuous oversight are becoming more valuable in a market environment that punishes emotional inconsistency. That does not make traditional investing obsolete, but it does mean traditional investing on its own may not be enough for every investor, especially if emotional execution, timing mistakes, and lack of adaptability remain major weaknesses. If the comparison is between a disciplined traditional portfolio and a weak black box algorithm, traditional investing is safer. If the comparison is between emotional, self-directed investing and a structured system with defined risk controls, human oversight, and consistent execution, the automated network has the advantage. And if the comparison is done properly, the conclusion becomes clear. The best capital protection does not come from choosing between human judgment and automation. It comes from combining them properly. That is exactly why a true automated trading network makes more sense than either extreme. It is more advanced than traditional investing alone because it improves execution discipline. And it is more robust than basic algo trading alone because it includes human oversight, risk structure, and a control framework built around the investor. That is the real evolution. Not replacing human thinking with machines. Not relying only on old methods because they feel safe, but building a system where technology handles execution and humans remain responsible for structure, risk, and oversight. That is a much stronger answer to modern market conditions. So, which protects capital better in 2026? AI or traditional investing? On their own, neither deserves blind trust. Traditional investing still offers clarity, familiarity, and long-term value. But when markets become faster, more complex, and more emotional, structure matters more than familiarity. And that is where a well-built, automated trading network stands apart. Not because it is just AI, not because it is just algorithmic trading, but because it combines disciplined automation with human oversight, predefined risk controls, investor transparency, and a structure designed to reduce the kinds of mistakes that damage capital over time. At Automated Trading Network, that is the lens behind the model. Clients operate inside their own regulated investment accounts. They maintain control of their capital. Technology is used for disciplined execution, and the broader framework is built around structure, not hype. If you want to understand how that works in more detail, review the information in the description. Take your time. Study the structure carefully. Compare it with other options. And make your decision based on how capital is actually protected, not how the marketing sounds. If this video helped you think more clearly about traditional investing, automation, and capital protection, subscribe and turn on notifications.